What's up, YouTube? Welcome back to Not Dumb Money. Today's video is the first of what I hope will be a series of educational videos. I don't want to make a generic stock market for beginners video. I want each video to cover a specific topic in a way that's actually useful. And today, I will talk about the price to earnings ratio, or the PE ratio. By the way, if you're not subscribed to the channel, please do. Your support would mean the world to me. All right, let's go. The PE ratio is the company's share price divided by its earnings per share. But what does the PE ratio tell you really? Let's take a very simple example. Apple's share price when markets closed August 23rd was $497.48. Its earnings per share over the past 12 months is $13.16. So let's take the share price divided by the earnings per share. That is a PE ratio of 37.8. You don't have to spend too much time calculating this manually. You can get a company's PE ratio for free from websites like Yahoo Finance and FinViz. Now back to the Apple example. A PE ratio of 37.8 means that if you buy Apple stock at $497.48, you're paying almost $38 for every dollar of profit Apple makes. Is this good? Is this bad? Well, it depends. When deciding if a company's PE ratio is too high, too low, or fair, you need to compare it with other PE ratios. You can compare it with PE ratios of its peers. You can compare it with the average PE ratio of the market. If a company's PE ratio is higher or lower than that of the market or its peers, you need to ask yourself why. You also need to look at what's called the forward PE ratio. The difference between the PE ratio and the forward PE ratio is that the forward PE ratio uses a company's expected earnings per share over the next 12 months, as opposed to the actual earnings per share over the previous 12 months. Typically, if a company is growing, the forward PE ratio is lower than the PE ratio. So, you just looked up a company's PE ratio. Let's call this company Company X. You compared Company X's PE ratio with the market's PE ratio and the PE ratios of its peers. The PE ratio of Company X seems very high compared to the market and most of its peers. Okay, next, I would look at the forward PE ratio. Well, Company X is growing, so its forward PE ratio is lower than its PE ratio. That's good. The ratio is still a little higher than most of its peers, though. Is the Company X overvalued? Well, we need to do a bit more research. Let's look at the historical growth of Company X and its peers. Okay, so Company X has been growing faster than its peers over the past 5 years. But will this continue? Well, let's look at Company X's expected earnings growth for the next 5 years. What do you know? Not only has it been growing faster than its peers, analysts expect that Company X's growth will continue to outpace its peers. Now, it's starting to make sense why Company X has a high PE ratio. Maybe it's not overvalued. I think you can tell where this is going. A high PE ratio typically means that investors are expecting high growth in the future. A high PE ratio could mean that a company is overvalued, but you need to do your research. On the flip side, a low PE ratio could mean that a company is undervalued, but it could also mean that investors are expecting the company's growth to be limited or even declining. Okay, so we talked about the PE ratio and the forward PE ratio, but there are other types of related ratios that can be useful. There's the price to earning to growth ratio, also known as the PEG or PEG ratio. The PEG ratio can give you more insight into a stock by measuring the relationship between the PE ratio and earnings growth. In a perfect world, every company would have a PEG ratio of 1, but we all know we do not live in a perfect world. At first glance, companies with a PEG ratio of less than 1 might be undervalued, and companies with a PEG ratio of more than 1 might be overvalued. However, you need to do research to understand why a company has a high or low PEG ratio. And again, you should compare a company's PEG ratio to that of its peers. So far, so good, but the PE ratio has its limitations too. For companies that are loss-making, think Uber, Lyft, Twitter, and many others, they don't have earnings, so you can't really use the PE ratio. You have to look at other metrics when evaluating those. All right. So, the PE ratio is a very popular tool that investors and analysts use to determine a stock's value. However, it's just one tool and should not be the only tool you use to make decisions on whether to buy or sell a stock. It should just be one part of your analysis. And we're done. Thank you so much for watching. Did you find this video useful? Did you learn something? What are your thoughts on how the PE ratio should be used when picking stocks? Please let me know in the comments. If you enjoyed this video, please do me a huge favor. Hit that like button, subscribe, and turn on the notifications bell. As always, it's been a pleasure. Much love. Peace.